Andrew Slimmon is here on set with us now. He's senior portfolio manager at Morgan Stanley. Andrew, I kind of wanted to pick up on that discussion we were just having, though, because you also have a take on how stocks are behaving. And the ones where we're seeing weakness are the ones where they're responsive to some of what's happening in Washington.
I have to agree with Dan. Sorry, Steve.
Oh.
Which is, if you look at the stocks that would be hurt by tariffs, in other words, they have high products coming out of China, they're not doing that badly. The stocks that are doing badly are the ones that would be hurt if there were big cutbacks in federal spending.
So can you give some examples?
DOGE,
Yeah.
the IT consultants, obviously the defense companies, more of those than companies that produce a lot of their products in China.
Like retailers?
Retailers. So I think it's an interesting commentary that maybe the market is telling you that people are overestimating tariffs, but maybe they're underestimating
DOGE.
So
one interesting.
And don't forget, the market started rallying in mid-October. Trump stocks started rallying in mid-October.
Oh, yes.
So the market accurately predicted the election.
It's been ahead on that. It's maybe looking around the corner now. The head of the National Retail Federation also told CNBC this week that he thinks retailers have 40% less exposure to China now than they did during the first administration. Skechers, there's been some of these individual examples where they're trying to get ahead of this a little bit. I just wonder, could this next round actually go to stocks or places that we don't anticipate? Will they look different? Maybe it's less about the retail supply chain and maybe, is it tech? Is it chips? Is it that sort of thing?
We haven't seen that yet. I'm just watching the consumer product companies, and they haven't really been hit as much as I would have thought. And versus, boy, these kind of government, companies that have high percentage of their revenues coming from the government, they're really been hit hard.
And yet it's hard to see that if you follow that out and say, okay, well, the defense companies, do we really think they're not going to have a tailwind? And look at what's going on globally. Do we think those who are contractors, for instance, I mean, the last time we've seen pressure on government employment, they've done more contracting at the end of the day. So I can't quite reason through some of those moves either.
Yeah.
So I don't know how that fits in for you, because you were very bullish this year, and correctly so, into what you foresee for the markets overall.
Well, it's really interesting. I've spent the last couple of days in New York talking to advisors and who are invested in our strategies. And last year, a year ago, or 2 years ago, they were lamenting to me that all they could do is all clients wanted to do was buy treasuries, 1-year treasuries and money market. And I'd come to see you and I'd say, Kelly,
yes,
people are too bearish.
Yes.
The pessimism is rampant. And now those advisors are nervous because their clients are calling up saying,
I want to be in fart coin or something.
Exactly.
Yeah.
I want speculation. And the reason why advisors are nervous is that reminds them of 2021 and what happened in 2022. All those stocks got destroyed. So to the extent that you have sell-offs like yesterday that reminds people, be wary of what you're doing here, I think that's really healthy for the market because there was too much speculation. We talk about value growth. Since July, the more risk you took, the better you've done. That's not a healthy thing. So but unfortunately, it doesn't take one pullback. People will step in and buy. So it takes multiple shots.
Are you bearish?
I'm not bearish. I just think that you have to be aware of the fact that I'm not coming to see you saying, hey, it's lonely over here in the bullish camp. It's getting more crowded now. I'm hearing a lot of people that were previously bearish. Now they're more bullish. It gets me a little bit more nervous.
I have a comment and a question I want to add. The first comment is I don't know what happened to conservatism when you used to say, well, if you put a 20% tax on something, it's bad for it. If that's true, if that's not true anymore, we should tax the wealthy a lot more. We'll have no diminution in work effort. All of a sudden, we're going to put lots of tariffs on it. It's not going to matter. That's my comment. You can comment on it if you want. The question I have is this. Yesterday, think about being out on the water, and you had the wind at your back, and all of a sudden the wind shifted. How much of a headwind now to the stock market is the Federal Reserve potentially?
The key difference to 2022 is the Fed was raising rates. Now they're just going to go slower.
Right. But
so that's still an good time to be invested in equities. But we need more volatility to remind people that you have to control your risk. And I haven't seen that, better part of this year so far. So I think that's healthy for the market.